Hi, it's Eric Nuttall of the Ninepoint Energy Fund and Ninepoint Energy Income Fund. It's Thursday, but my gosh, it feels like a very, very long week given the pummeling that has occurred in energy stocks as we've been in a very much risk-off market, as there's concerns about recessions and the NASDAQ and meme stocks imploding and Bitcoin, et cetera. And so the intent of this was just to provide a very punchy 5-minute, give or take, update in terms of what are our thoughts on oil, what are our thoughts on energy stocks, and to provide some comfort, because clearly on a day like today where oil is up $2, yet energy stocks are down 6, 7, 8%, there feels like there's a bust. So what is going on? There is strong concerns with the Federal Reserve raising interest rates, clearly that the world could be entering into a recession. Energy investors clearly are beginning to be worried about, okay, well, what does that mean for oil? What we've been writing about for a long, long time, our thesis about why oil is in a multi-year bull market, why we think oil, the price is heading meaningfully higher in the quarters and years to come, remains valid. And so why do we remain convinced of that call? One does relate to demand. Very clearly, when we account for China emerging out of regional lockdowns, we believe that global demand is back to prior COVID levels. We're seeing strong surge in travel-related demand as we're all emerging out of lockdown. Governments are reducing hindrances to travel, et cetera. Online websites reporting that the demand for travel is up like 3x, 4x, et cetera. And so it's not a demand issue short term. When we look at the challenges then on supply, whether it's on US shale, whether it's on OPEC, whether it's on the global super majors, those all very much remain intact. We were in New York last week. We met with a variety of shale companies. We think the model of low to no growth, despite what the White House is asking for, the model going forward is low to no growth, maximize free cash flow, and distribute it back to shareholders in the form of variable dividends and buybacks. That has not changed. We had the good fortune to have dinner with the Secretary General of OPEC. What an experience. He earlier that day in front of everyone basically said that, well, and did say that OPEC is running out of spare capacity, which is a watershed event for the sector, something we've been writing about for well over a year. And so that call we feel pretty good about, given that the head of OPEC just said that our thesis is correct. And then the global super majors, the ongoing lack of investment, lack of growth, et cetera. And so when we look at it, we've seen inventories continue to fall. Yes, they're rising due to SPR release, Strategic Petroleum Reserve releases. That will come to an end in a couple of months' time, magically right ahead of the US midterm election. And then we expect that trend to continue. And so inventories remain critically low. Inventory trajectory, when we account for the SPR releases, continue to fall very, very meaningfully. And so this concern about a recession, I truly think, is unfounded, because fear not what is actually necessary to balance the market. The chasm, we think the market is undersupplied by about 1.5 million barrels per day right now. And so just to balance the market, we think demand will continue to grow. The IEA was out yesterday, I believe, calling for another strong year of demand growth in 2023, as we expect. And so as we look at continued demand, with an OPEC that will be reaching exhaustion of spare capacity in the coming months, of shale companies that we think can grow at most by 600,000 to 800,000 barrels per day, of the global super majors that are largely in decline, the question going forward is, where are those barrels going to come from? How do we fix the structural deficit that oil is in? And what you need is demand destruction, which is what people are fearful of. They're thinking, my gosh, we go into a recession, there's going to be demand destruction and oil is going to fall off. And yet what I'm trying to clearly communicate to you is that is exactly what the oil market needs to balance the market and avoid further drawdowns in inventory. So need not be worried about the very thing that is required and the thing that we've actually been calling for. The question is, at what oil price does that occur? It's not $117, $120 where we are now. Perhaps it's no longer 180. That's the historical rule of thumb. And yet we're seeing, from a lack of refining capacity globally, the barrels, end products, gasoline and such, are trading at very elevated levels. So maybe it's only 150, maybe it's 140, but it's higher than where we are today. The opportunity for energy investors, when I look at the fund, the primary fund that I manage, our average holdings, we believe, are discounting an oil price below $60. We model every company in North America between $60 and $120 oil. When we look at today at $100 oil, which we think is a pretty good fundamental floor, financial markets overshoot to the up and down. Certainly we saw that with negative oil pricing. But when we look at what is the average energy stock trading at today, we own 14 holdings. They're trading on average, we estimate 2.1 times enterprise value to cash flow and a 31% free cash flow yield. And importantly, they have all pledged to return 75 to 100% of that free cash flow back to us once they hit their leverage metrics, which is occurring in real time and at most by this time next year. And so when we look at our average holding having 16 years of production, therefore a free cash flow annuity, we're only paying for 2 years of those on average. So we're getting 14 years of 31% returns, defined as dividends or buybacks, combination thereof, for free. And so when we look at opportunities today, we do view a 6% sell-off with oil up as an opportunity for those that may have missed this trade over the past 2 years, despite our best efforts. But the comfort blanket that I can provide to you is know what you own. And so we do as best work as we can to look at the holdings, where are they trading, what is the return relative to the risk that we're taking on. And so when I can look at names trading at a third to a quarter of historical valuations, using an oil price $20 lower than where we sit today, where even stripped today, the 2023 strip is just a snick below $100 per barrel. And with companies where we have a catalyst that is leading to a re-rating, where these companies have pledged the return of capital. So we're going to see continued increases in dividends, share buybacks. We just saw an SIB by one large company. I think we're going to see that going forward. And so the primary purpose of this very quick conversation is to say we are seeing absolutely nothing thesis changing. The key tenets of our multi-year bull market thesis remain intact. We see continued demand growth going forward. We just met with the biggest shale companies. They reaffirmed our view that the model going forward is low to no growth. And in fact, our takeaway from our meetings was we were surprised at how little inventory depth there was in some situations. We had dinner with the Secretary General of OPEC, a very warm, very insightful, and shockingly open gentleman who said to us and earlier that day, OPEC is coming, the exhaustion of OPEC spare capacity is coming. And this is a threat, I think that was the words he used, that the world must come to grips with. And then the global super majors aren't growing. And so when we look at, again, sell-offs like today, where this week, the stocks are down 10% or so, I leave it to you to decide whether you view that to be a generational opportunity or not, where you can get 14 years on average of free cash flow of 31% free cash flow yields for free. And so hopefully this is helpful. Continue to look for updates on Twitter and the Financial Post and such. And we look forward to providing future updates to you. So thank you for your time.